Today's show is brought to you by Grayscale. Curious about investing in crypto and not sure where to start? Start with Grayscale. Grayscale is the world's largest crypto-native asset manager and has been in crypto since 2013. That's a long time when you consider how early we still are in crypto adoption. Grayscale offers the widest selection of crypto investment products in the U.S., over 30 different funds for investors to choose from. That's plenty of choice for both first-time crypto investors or crypto experts. You may not be considering crypto for your portfolio today, but whenever you're ready, Grayscale can be your guide. Invest in your share of the future. Investing involves risk, including loss of principal. For more information, visit grayscale.com. Pay attention. This is going to be one of the most provocative pieces of asset allocation advice you'll hear all year. I'm super excited to introduce you to my guest today on Live from the Compound. His name should need no introduction, but you're going to get one anyway. Ric Edelman. Ric is the founder of Edelman Financial Engines, an RIA with $300 billion plus in AUM. Ric is a New York Times best-selling author and is the founder of the Digital Assets Council of Financial Professionals. Ric's been here before. Ric, so nice to have you back.
Always a pleasure, Josh.
Okay. How's that for an intro?
Oh, I loved it. I mean, it was as if I wrote it.
All right. You have a white paper out. Nobody has seen this yet, my understanding is. It's coming out today?
It's brand new today.
Brand new today. All right. I read it over the weekend. Thank you for that. And I kind of I know the way you write, and I kind of expected some hyperbole, and this did not disappoint. The paper is called The Death of 60/40 and Why Your Crypto Allocation Should Be 10 to 40%. I want to give people the background before we dive into the paper itself.
Sure.
There's a very short list of people from the traditional wealth management, financial planning industry that have been bullish on crypto since triple digits. You're in that group. I think it's like you, Matt Hogan, Tyrone Ross. There's probably 4 or 5 other names, but that's it. You've been, I guess at this point, you could consider yourself to be crypto native. Tell us a little bit about that background before we dive into what you're proposing today.
Sure. Well, as you know, I'm an RIA first,
yes.
Having created EFE, but I'm always focused on what's next, what's coming to anticipate what our clients are going to need. And that's what most of my books are all about, not just what you should do today, but what you should plan for in the future.
You think big and on long timelines.
I try to.
Yeah.
And in 2012, I was introduced to Bitcoin. And like everybody else, I wasn't looking for it. It came to me.
Right.
And my first reaction was the same as everybody. Huh? What? Digital money? Made no sense. But the people who were talking about it with me were really smart. And I figured if they get it and I don't, there must be a there. So I need to figure this out to understand what they know.
The people themselves were too smart to dismiss it out of hand.
Correct.
Okay.
And that's what I find most do when they first hear about Bitcoin. They wave it off as either a fad or a fraud. If it isn't tulip bulbs, it's a Beanie Baby. And they just ignore it. And if you're not intellectually curious, you shouldn't be managing other people's money. So I've always been curious. And so I delved into it in 2013 to figure out, what is this? Is it real? Should I care? And I concluded pretty quickly 2 things. Number one, crypto blockchain technology is transformative, will alter commerce on a global scale. Second, those of us in the traditional financial services industry don't know that because we didn't invent it. It came outside of Wall Street. Yeah. And so I created DACFP, the Digital Assets Council of Financial Professionals, in 2015 as a crypto education company. We don't manage money. We're not endorsing Bitcoin. We're simply trying to help you understand what is it and why should you care and what role does it play in your financial planning practice, if any. And so I first started investing in Bitcoin when it was about $700, and have never sold, been investing ever since in it and other aspects of crypto.
In fairness to the people who dismissed it early on, the original idea behind crypto was not as a portfolio allocation because it's an investable instrument. The original idea was not crypto, it was cryptocurrency.
Yes.
And I think that's the part that, number one, has not been fulfilled.
Correct.
And number two, is where people got off.
Yes.
Because they said, I have a Visa, I have dollars, I don't see what problem this solves. Now we think of it more as, no, actually, this is an investment in the network itself, and it's probably best thought of as a replacement for something like gold. And that, I think, is a big thing that's changed. Bitcoin specifically.
I would agree with you. It has matured and developed and expanded in ways that were never anticipated in 2009 when it first came into the marketplace. And you weren't crazy back in 2012 2012 or 2017 or 2022 not to have invested. In fact, my white paper back in January was on the 6 biggest myths that are preventing people from investing today. And myth number 1 is, I don't want to admit I was wrong in not investing. You weren't wrong.
It's a big one.
Yeah, you weren't wrong. You were smart. You were prudent. You were a professional. That's why you didn't buy it. It was uncertain. It was untested. We didn't know what the government reaction was going to be. We didn't know if it would become technologically obsolete. And it was wildly volatile. Yeah. You were smart not to buy it back then. You were prudent. But that was then. Today is totally different. As you noted, Josh, the circumstances, the environment, the technology, the institutional and government adoption, radically different. And that is why you need a fresh new look.
You and I had a conversation at the bottom of the last crypto winter in Austin at your DAC FP event.
Right.
And I remember being on stage with you. And this is around the time where the political witch hunt is in full flame. They are literally arresting people, charging people, hunting people internationally.
Yes.
Sam Bankman-Fried's fraud had just unraveled. Celebrities were being served lawsuits for appearing in Super Bowl commercials for various crypto websites. And it really felt like those were the most pitch black times for the asset class, if you will. And you were fairly steadfast. I was coming from the perspective of, I'm a fiduciary and I'm regulated, and I'm not, whatever my opinions are on crypto, the government has different opinions, and I'm staying out of the fight. We went from that moment, I think within a year, to there was a guy running for office who wants to create a strategic Bitcoin reserve.
Right.
It was one of the biggest about faces societally I've ever seen for an investable asset. You see it that way?
Very much so. And yet back then, when you and I were on stage together, there was no certainty that that was going to happen.
No.
Which is another reason why you were prudent not to engage. It was also incredibly cumbersome and difficult, inconvenient, and a little scary to engage because there was no established method within the securities regulated environment to do that. And so you weren't crazy to stay on the sidelines. I'm the one who was probably crazy by boldly going as early as I did. But today it's radically different. Today we have ETFs that invest in Bitcoin and Ethereum. We have buffer ETFs, yield ETFs. We have options trading, a massive options market. We have endowments, pension funds, institutional investors, hedge funds, sovereign wealth funds.
You also have record highs. Which helps everyone and everything.
Isn't that notorious? We all love to buy at the high and sell at the low. Well, go figure.
Right.
So the winds at our backs. The Trump administration has reversed all of the Biden era prohibitions that existed.
Gary Gensler is out at the SEC.
We have now every political appointee of Trump, a strong crypto supporter, from the Secretary of the Treasury, Labor, Commerce, the head of the SBA, the head of OCC, CFTC, SEC, FDIC, all of them strong crypto supporters. Everybody in Congress, majority of both parties are strong crypto supporters, including the key chairs of the Senate Finance Committee, the House Ways and Means Committee, the Agriculture Committee, and the Digital Asset Subcommittees. And this is why you're seeing massive movement toward acceptance and engagement. And now, for the first time, banks and brokerage firms are allowed to trade, custody, and engage in Bitcoin and crypto the way they do every other asset class.
There are guidelines now.
Yes.
When prior it was, here's the existing security law, go figure it out for yourself. And if you don't dot one I, we're coming for you. And that's over.
The poster child of how bad it was when the Department of Labor in 2022 said that any 401k plan sponsor that dares offer Bitcoin in their plan, we're going to investigate you and take appropriate action. Scared the bejeebers out of everybody in the K business.
They put a bank out of business. Signature Bank was clearing or custodying crypto, and they knocked it over.
They wouldn't even allow banks to open bank accounts of crypto companies.
That's right.
And so they
knocked over a bank for custodying crypto business.
Not the crypto itself, just the dollars that the bank was earning.
Almost like the concern with federal banking rules and cannabis. They kind of like...
It was the same.
Yeah, okay. I want to ask you one more question about the past, and then we'll get to the present and the future. It seems to me that this could have gone either way. The Democrats could have been the leading proponents politically of crypto when you think about the angle of we need remittances that aren't so expensive for people who are trying to send money back home, that's obviously a Democrat issue. We need to bank the unbanked. Of course, that would be bread and butter, a Democrat issue. But I think the combination of Elizabeth Warren being basically a no on anything that looks like innovation, and maybe some alignment between very online people on Twitter who are libertarian being also in the most vocally pro-crypto camp, just kind of kept the Democrats in a stance where they were pushing it away. They wanted nothing to do with it. But it didn't have to go that way. The Republicans embraced it. Number one, they saw the money there, and they saw that that money could be, if channeled properly through political action committees, could be very powerful to unseat incumbents as it did in, for example, Ohio. They also saw that it was of a piece with just deregulating finance in general. And I think for whatever reason, it was on the fence and it fell over into being a Republican technology, a Republican idea. Do you see it the same way, that it was almost one, but it ended up being the other?
Yeah, I do, Josh. As always, you're right on top of all of this. There were two major issues philosophically. First, Elizabeth Warren and her ilk hate loss of control. They want to be able to put their thumb on commerce, generally speaking. And
decentralizing makes it harder to have your hands on every transaction.
Exactly.
Okay.
The second issue is that, remember that Donald Trump in 2017 said that he thought Bitcoin was only good for scams and frauds. He was opposed to crypto. But you fast forward to this past election season in 2024, and he recognized two things, and you cited one of them. Number one, he recognized that the crypto community had amassed $200 million in PAC money that they were distributing to pro-crypto candidates. Up for grabs. Right. Biden wasn't grabbing it. Kamala Harris wasn't grabbing it. So Trump decided to. Second is that 60 million U.S. adults, in other words, voters, personally own Bitcoin.
Is that a third of the adults in the country?
Yeah. And Biden and Harris were threatening to render Bitcoin worthless. And that said to those 60 million adults, we're going to confiscate your money.
Yeah, guess what? I'm not an independent anymore. These people want to ruin my life, and these people are open-minded.
So Trump,
I think I know who I want to align with.
Trump goes to the Bitcoin conference in the summer of 24 and announces, I want to make the United States the crypto capital of the planet. Ta-da! He gets the crypto vote, and he gets the crypto PAC money. And that significantly helped in his movement toward the election.
Yeah, there's this big shock. Like, why did Gen Z, why did young males, young white males who ordinarily would be up for grabs in every district, in every region, well, it turns out they really like crypto. And they found the same thing, by the way, with every race. Young men of every race are highly interested in crypto. And the Democrats were just like ceding that vote.
There were 59 Senate and House races where crypto was a major political issue. And the pro-crypto candidate won in 57 of the 59.
Wow.
Including Ohio that you mentioned, Bernie Moreno, who I had as keynoting at my crypto conference this year that you did 2 years ago. Bernie Moreno unseated Sherrod Brown, who was the powerful chairman of the Senate Banking Committee.
Yeah, had
been in Congress 18 years. And Bernie Moreno, who is a crypto entrepreneur, who's one of the most impactful in the blockchain field, unseated him.
Right. And this was one of the unsung biggest motivators to get people out to vote who probably had never voted before.
But you said something really important that is worth elaborating, and you used the word remittances. Because even today, what a lot of advisors say to me is, I get it, I understand the hype, I hear all this stuff, but
there's no use case.
Yeah, why do we need it? What's the big deal?
These are people who are very comfortable living middle-class, upper-class lives. They've never had the need to send money somewhere.
And that's the whole point, is that as an American, we really don't need crypto, if you think about it, because we have a banking system. Look, we all love to hate banks, but it works pretty darn well.
Yeah.
We get our paychecks direct deposited. We're on automatic bill pay. We know the money is there. It's not going to get lost or absconded by the government. It might get eroded by inflation horribly, but we all just shrug at that one. That's true in the United States, but it isn't true for 1 billion people around the world, where they have corrupt governments that nationalize bank accounts, where you have unstable currencies with massive inflation like Argentina, Zimbabwe,
Venezuela,
El Salvador.
Forced into money laundering activities.
Exactly.
Because they're afraid of what their government will do to the value of their assets.
Or even the people, as you said, who are unbanked or underbanked, 1 billion according to the UN. In fact, FDIC says 7% of U.S. households, 20 million households, don't have enough money to open a bank account because of the minimum deposits or the fees associated. And if you don't have a bank account, you're excluded from the financial services industry. Good luck getting a job if you don't have a bank account to have direct deposit. Good luck being able to pay your bills or even store your money safely other than under your mattress. So crypto is important for the 7 billion people around the world who aren't lucky enough to live in a first world nation.
So this is one of the reasons why I think the greatest innovation of the entire crypto revolution so far. Yes, of course, Bitcoin is the most exciting thing to happen and people have made a ton of money. But stablecoins really are the answer to what you were just discussing. Somebody asked me to explain a stablecoin probably 4 years ago. The way I'm explaining it to elderly Jewish grandparents, people that they don't need to understand this. They're like, it's fine. But they wanted to. They were curious. The idea of a dollar being worth $1 all over the world, no matter where you go, it's not an anti-US dollar idea. It's actually a pro-US dollar idea.
Right.
And the way I put it to them is that their parents probably arrived on Ellis Island with just the garments on their back, and sewn into the lining of a jacket would be a few diamonds or some gold, whatever they could carry but needed to carry secretly,
right,
to literally establish a new life here. This is the way stablecoins, this is the revolution that we could see. You've got refugee populations all over the world. You've got people forced not only to leave their country, but leave their part of the country, go to another part of the country, transporting wealth while you're literally fleeing for your life. If there's a digital solution that you can upload everything you own into the cloud, arrive somewhere else, get yourself settled, and then download that wealth back to yourself, it seems very 2025.
And you don't even need a bank account. You don't even need a smartphone. An ordinary cell phone is all you need to do this. And it allows you to send money home to mama, who's still in the old country, after you emigrate to the United States for economic opportunity. And about $1.2 trillion is moved every year from one country to another by immigrants sending money back home to mama.
Yeah.
And mama doesn't need a bank account. She doesn't need to live anywhere near a bank. And this is transformative on a global scale.
Okay. So your white paper, should I quote from you? I want you to tell the story, but let me give people let's not bury the lead. The traditional 60-40 stock bond allocation model is dead. Oh no, not that again. This is due to unprecedented rates of longevity brought about by remarkable advances in exponential technologies. After 39 years in the financial services field, I'm announcing for the first time the correct crypto allocation. Conservative investors should now have 10% of their assets in crypto. Moderate should have 25%. And you say aggressive clients, I'm reading that as younger or more willing to bear risk, should allocate 40% of their investments to crypto. Is that scientific? Is that ballpark? How do you come up with that number?
I'll call it a little bit of ballpark, but there is some science behind it. There are some MPT statistics that support all of this. The fundamental thing is that, and yes, we've been hearing for a couple of years now, 60-40 is dead. I take a little bit of a different approach by putting the longevity curve on it. We are still, most advisors, using a 60-40 model as the base case. And as the client reaches their 70s, they're radically reducing the 60.
Yeah, on the 80% bonds, 20% stocks.
Exactly.
And then falling from there.
We've been doing that since I got in this business in the 1980s. This is so out of date because we're living longer than ever. 90% of all the people in world history who ever made it to age 90 are alive right now. Odds are really good, according to the scientists who study this stuff, that if you're alive in 2030, that's just 4.5 years from now. If you're alive in 2030, odds are high you'll live to age 100 or beyond. If that proves true,
stocks will not be enough.
Exactly.
And bonds will certainly lose ground to inflation.
So we need allocations of 70-30, 80-20, and well into your 80s, not simply into your 60s.
Okay.
So we need to have a much more equity allocation. Crypto is the ultimate of all equities. And when you look at the development of this technology and you compare it to the expectations that the world has for the growth and development of the S&P 500 or tech stocks or other market sectors, everybody that I have encountered is in pretty strong agreement. Crypto will outperform other market sectors for the next decade.
Now, where does the crypto allocation comes from? Directly out of stocks or not necessarily?
Yes. In other words, if you're going to increase your equity allocation to 80%, then half of that ought to be crypto-based, and the other half should be more typical equities.
I want to show somebody the first of several graphics that come from your white paper. John, can you put projected 2030 market size on screen? So what you're doing here is talking about exponential technology in general, and you categorize Bitcoin and tokenization as being in this exponential technology bucket. I know your work well enough to tell people when Ric talks about exponential technology, he's not talking about FANG stocks. He's not talking about social media and cell phones. He's talking about literally life-changing technologies that will change the curve of how long people live, change the way we live our lives, change the way we transport things. So in this list, you've got, for people listening, obviously robotics, wearables, big data, cybersecurity, blockchain, Internet of Things, metaverse. Each of those technologies is 5 trillion or smaller projected 2030 market size. But then you've got two outliers. You've got tokenization, which you think is a $16 trillion exponential technology market, and Bitcoin at 19 trillion. These aren't revenue numbers. These are asset.
This is the market cap.
So this is the amount of money invested in these things.
Yeah, this is about what the value of these industries are going to be.
So how do you calculate? Because some of these things, like multiple of these technologies, would all fall under one umbrella for certain companies. Wearables and robotics, for example, come to mind. So how do you tease out these dollar amounts? Where do these numbers come from?
The tokenization projection comes from both McKinsey and from the Boston Consulting Group. Okay. Tokenization is in its infancy today, and everybody in the financial services sector is racing to develop and expand the tokenization marketplace. I posted on LinkedIn about a month ago, got 40,000 hits when I said that ETFs won't exist by the end of the decade. They'll all be replaced by tokenization. Tokenization is the new thing in asset management. We know how ETFs have revolutionized the money management industry compared to mutual funds. We know how mutual funds did it to individual securities, and tokens are going to be the thing that outdoes ETFs.
Walk me through that. So SPY probably has 300 billion in it or something like that, right?
Yeah.
Okay, so that's the largest ETF. It's the most plain vanilla. It's the S&P 500. It trades every day, liquid as water. How does tokenization improve that product?
It's not liquid as water. That's part of the problem.
Okay.
Is that
There's a bid-ask spread of 2 cents?
There's a significant bid-ask spread. When you add it up for over time, that is a significant spread. You also have a far higher cost, even though it's, 5 bips? It's a far higher cost than needs to be. You also have significant friction because of the intermediary functionality of this. You have to take your money, give it to a broker, put it in a brokerage account. That brokerage account has to deal with counterparty. The whole process takes a while. And worst of all, you can only do this Monday through Friday, 9:30 to 4, except for holidays.
Well, that's changing too, but yeah.
Slowly. And the whole settlement process of T+1, we're going to T+ immediate. We're going to a frictionless
Instant
environment.
Settlement.
Totally instantaneous, totally transparent, no intermediary, and most important, total safety from a cybersecurity perspective. We've seen the hacks of everybody with the exception of the Bitcoin blockchain. These decentralized blockchains are far safer from a cybersecurity perspective than any other technology developed. The transparency is better than anything we have seen. The ability to be inclusive is better than anything because of the demonetization that occurs and the democratization that arises, allowing anybody to engage in fractionalized shares, is why we're going to take current shares of stocks and ETFs of stocks and turn them into tokens of stocks.
Which will happen first? Individual company stocks become tokenized, or baskets like ETFs?
Both are already underway. You already see crypto companies that are providing this opportunity already in its infancy, but it goes beyond stocks. You're going to be able to see tokenization of real estate first. The first tokenized project was in 2018, a condo here in Manhattan. The St. Regis in Aspen was tokenized. Major buildings in Dubai are being tokenized because the global real estate market is 3 times bigger than the global stock market.
Does tokenizing a piece of real estate turn it into a de facto security?
Absolutely.
Okay.
And that's part of the good news because we take a highly expensive illiquid asset and we now make it liquid and demonetized because nobody can afford except pension funds and insurance companies.
Let's take the Aspen example. Walk us through this. So what whose resort is this? St. Regis?
St. Regis.
Okay. So I don't know. Let's hypothetically say it's a $100 million facility.
Yeah. Turn it into a token of $10 a piece.
Okay. So now somebody that wants to be a resident there and own a piece of the property can buy it in smaller increments via tokenization.
Right.
They do not have to sign paperwork and become a K1 LP of whatever private equity firm controls it. Now, all of a sudden, it can trade. Somebody owns it. They could sell it. Somebody new can come in. Is that tied at all to having a residence there?
No,
or
not at
necessarily.
All. First of all, it's a hotel, so you're just an investor.
Hotel. Okay.
Yeah, you're just an investor, and being an investor, I remember when Wrigley Gum sent chewing gum to all their shareholders every year.
Yeah.
If you go to the St. Regis and you own one of these tokens, they'll give you a discount on the room.
Now you own this. What do you get? Is there a cash flow that's paid through in a tokenized way, or do you just own effectively equity in the property that you can sell at hopefully a higher price someday?
You own equity in the property, and what some of these tokens are doing are sending what are called airdrops, which is essentially a dividend, where you get more, in-kind payments. So you get more tokens.
You more tokens of the property.
Exactly.
Is that dilutive, or is that coming from someone else?
No, it's not dilutive because you're getting. Well, you could argue it's dilutive in the same way a stock dividend that's paid in kind. Exactly. Okay. You could argue that. It is taxable. There's some debate in tax circles as to you pay the tax on receipt or do you pay the tax when you sell it. It's an example where the IRS has to create more regs of clarity in the crypto space. But let me give you a more fundamental example of how transformative this is. Because we can do this to the IBM building, we can do it to the Sears Tower, we can do it to name your big building where individual investors are excluded because they don't have the money to engage. Now, if you demonetize by offering $10 tokens on a $1 billion building, everybody can participate. Turn it into your house. We know that for most Americans, their home is their biggest asset. When they reach retirement, it's an illiquid asset. They need more income in retirement. They don't want to sell the house. They don't want to
reverse mortgage.
We certainly don't want that. So they can now tokenize that $1 million house into 1 million tokens of $1 each, selling them off as they choose to generate income.
Now, why would somebody? I understand the reason to sell it. You're creating liquidity without losing the house.
Right.
Why would somebody buy a tokenized interest in my house?
For the same reason you would make any real estate investment. We know that institutional investors own 30% of all the residential real estate in Denver and in Phoenix and a lot of other major cities. They recognize that they can generate growth from appreciation. They can also generate tax benefits from being a real estate investor. They also can, when that property gets rented, turn it into rental income. So the same reason applies. In other words, you're not doing this as an investor for anything unusual. It's simply becoming available. So we're tokenizing exotic cars.
They have no vote. They have no say. If I have a home that is listed at $2 million and I decide I'm going to paint the whole thing black and I'm going to, I don't know, put spikes on the roof and I'm going to allow, I don't know, like all manner of disruption to the value of the home, you, the token holder, have no say. That's what separates it from shareholder votes in a corporation with a board of directors.
Unless, you're right, unless that home is being tokenized via a DAO, a decentralized autonomous organization.
In that case, the homeowner is part of that decision.
Yes, in that case, everyone who owns a token has a vote.
Okay, gotcha. All right, so tokenization, you think, is going to be as big as the market value in Bitcoin?
I'll give you a simple example. Look at Franklin Templeton, which is leading the way in tokenization, and BlackRock, which is doing this as well. Larry Fink's letter last week, his annual shareholder letter, cited tokenization as the next major thing. In other words, instead of having 15 or 20 asset classes that we currently use to build a portfolio, you're going to have 15,000 asset classes. Everything will be tokenized, from comic books and rare coins to artwork, exotic cars, old wines. Everything you can think of that is a real world asset will have a token associated with it, creating astonishing opportunities for portfolio customization.
So this would be part of that, let's say hypothetical 40% allocation into crypto.
Correct.
It's not all Bitcoin and ETH.
Correct.
There would be tokenized real estate would fill a slot, let's say hypothetically.
As well as the companies that are making all this happen. So companies like Coinbase, which are the crypto exchanges where you'll trade, companies that are providing the crypto tokenization that facilitate the development of these real world assets into digital tokens. Companies like the digital banks that are allowing you to hold the assets. Companies like Circle, which has just gone public, a major stablecoin company.
So you would throw those equities into the crypto bucket?
Correct.
Okay, and they're getting big.
Yes, and the whole point being you want diversification in crypto the same way you want diversification in equities.
So let's talk Circle for a moment. Came public about a week and a half ago. The 7th largest IPO of all time. Only raised $1 billion. I guess I shouldn't say only. That would have been unthinkable 2 years ago, that a crypto company was going to raise $1 billion on the New York Stock Exchange or the NASDAQ. But they did. The stock, I think, has quadrupled since coming public. Obviously, what that demonstrates is massive institutional demand for companies that have figured out a way to become a cornerstone of the crypto ecosystem. Undeniable. You don't have to buy it. You don't have to like the valuation. What you can't deny is that other people do.
Exactly right. And you have to understand why that is and why Congress is passing as its first crypto bill
The Genius Act.
a stablecoin bill.
Yeah.
It's the low-hanging fruit because everybody, even Elizabeth Warren, has to admit that stable coins matter because they strengthen and support the dollar rather than compete with it. And this is why the Treasury Department loves stable
They reaffirm
coins.
the importance of they reaffirm the centricity of the dollar in the global financial system by pegging their value to the dollar.
Right. When you when you take your dollar, turn it into a stable coin, they take that and put it into a USD bill.
Very specifically, part of the Genius Act precludes stablecoins themselves from paying interest because they don't want this new technology to immediately render the banking system, let's just call it redundant for now.
Which is why BlackRock and Franklin both created on-chain money market funds that look an awful lot like stablecoins, except they do pay yield.
And they don't call them stablecoins.
They don't call them stablecoins. They call them on-chain money market funds. You don't buy them in a brokerage account. They're an online app on your phone. They are cheaper and therefore higher yielding, and they're safer. They're immediate. They're 24/7, 365. And they've already, between the two of them, amassed nearly $3 trillion.
Are they investing in the same traditional money market instruments that a money market mutual fund would?
Yes.
Okay, so they're buying treasuries?
Treasuries,
T-bills,
commercial paper.
Okay.
Right.
Are they rated? Do the ratings agencies even look at these or not yet?
I haven't noticed, but if they do get rated, they would be rated AAA like all the other money market funds.
Okay. One of the things about Circle that's come up since the success of its share price is how reliant the company is on the continued partnership with Coinbase. It's the house stablecoin at Coinbase. The problem is it pays Coinbase a ton of money in what we refer to as distribution costs. And paradoxically, the more money that comes into Circle via Coinbase accounts, the higher those payments go, but not in a proportional way.
Yeah.
And this is, I think, at the heart of the bear case on Circle, but maybe there's more to the story that I don't understand.
No, I'll even expand on that point. Everybody's paying attention to the Bitcoin ETFs with $100 billion in assets. Almost all of them custody their Bitcoin at Coinbase. They all pay Coinbase fees. The funny thing is Coinbase is making much more money on these ETFs than any of the ETF sponsors are.
In custody fees.
Exactly.
Okay.
And we've centralized, because of that, Coinbase is a centralized crypto exchange. We've centralized a decentralized technology, which the crypto maximalists saying, this is nuts. Why are we doing
This
that?
wasn't what Satoshi had in mind.
Right.
Wait, hold on. Coinbase is making all the money and Coinbase's top shareholder is BlackRock, second shareholders Vanguard. What did we do?
And it's trading in the S&P.
Right.
So, yeah.
Let's put this Tether graphic up, John. I thought this was an interesting slide. You're saying this explains why Tether, the largest stablecoin, generated $13 billion in EBITDA in 2024. Nobody knows that, by the way. more profit than dozens of America's largest corporations. So take that $13 billion in cash flow that Tether generated. That's more money than McDonald's, John Deere, BlackRock, GE, Salesforce, Target, Ford, Abbott Labs, Delta, IBM, Charles Schwab. Can that be true?
Think about this. I'm going to give you money.
Yeah.
You're going to manage it for me for free. You're going to take the money and buy treasuries.
No return for you.
None.
Right. All you want back is
access to the money.
Nominally, the dollars that you put in.
Right.
And I could do whatever I want.
And you're going to put the money in treasuries and you're going to keep the yield.
This is maybe the greatest business. This is maybe the greatest business that nobody believes in.
Why the hell didn't I think of this back in 2012?
Right. Tether is super controversial because of, and I haven't been keeping up to date, but the complaint about Tether is nobody knows what they're actually investing in.
And this is the reason for the Genius Act is that there's no regulation right now. Tether's offshore, and there's no requirement that they buy treasuries. There's no requirement that they disclose what they're doing with the money.
Will they conform now in the wake of this this law passing?
Well, the law hasn't been signed yet, but
Right.
that's the anticipation. This is why Circle went public first, because they're a U.S.-based company. They're conforming to all U.S. laws. They're doing audits. They're doing disclosures. They're conforming to all U.S. Rules that exist, and they're going to conform to the Stable Act. And that's why it was easier for everybody to support a Circle IPO than a Tether IPO.
If JP Morgan has a coin and Fidelity has a stable coin, and Fidelity has a stable coin, and someday probably Schwab has a stable coin, and this just becomes a standard thing that all large financial institutions offer, is it too late? Has Circle already built up the network effects to where they're unassailable? Or do you think there will be many of these?
There's going to be many. It's not too late for everyone to get engaged because even Circle doesn't have all that much money yet. Nobody's got trillions of dollars, which is why all the major banks, JP Morgan, Bank of America, Citi, and Wells have announced a consortium to jointly create a stable coin they'll all use. Fiserv just announced yesterday that they're creating a stable coin that their 3,000 community and regional banks are going to use. And 2 weeks ago, Amazon and Walmart independently announced they're going to create their own stable coins.
Okay.
So basically, remember when you used to go to Disney and they had Disney dollars?
Yes.
Well, you now are going to be a customer of Walmart. It's going to be like loyalty rewards structure.
So if they can get you to download the app because that's your wallet and it's filled with Walmart digital dollars that either from returns or whatever, no one's going to walk away from that money.
Exactly right. And you also have the benefit, I believe, of Walmart and Amazon with their reputational concerns. They're not going to let anything go wrong with that stable coin.
Will there be interoperability between so if you're a regular consumer, you probably don't want to hold 7 different currencies. You probably don't want your dollars and all these different stable coins. It becomes really difficult to manage and understand what you have. Is that the role that Coinbase plays, or will the banks play that role? Who's going to help you keep track and keep custody of everything?
I think that's going to be a huge business opportunity as someone is going to come out being the fundamental wallet of choice.
Switzerland.
Exactly. That holds and facilitates arrangements with everybody else. Think about, I've got a PayPal account and a Venmo account and a Zelle account.
Yeah.
How annoying.
So annoying.
And so having a single provider that gives me access, a hub and spoke approach is where the future is going to be.
Okay. Now, you are not counting stable coins in this crypto allocation because they're effectively
cash,
a yield-free money market.
Right.
It's worse than cash.
Correct. Yeah,
okay.
You're right.
From an investable standpoint.
Yes, correct.
Okay, so that's not part of what you're doing.
Correct.
Okay, got it. Let's put this graphic up with the allocations. So walk me through what this means. It's a graphic ranging from 0% crypto up to 40 with Bitcoin valuations?
Yeah, so these are two projected outcomes. So the theory is you take a 60-40 portfolio, you invest $100 for 5 years. We're going to ignore taxes. If you have a zero allocation, that's a typical 60-40 at the top of the chart. If Bitcoin blows up and becomes worthless, you have a 100% loss. At the end of 5 years, because you didn't own any crypto, your $100 at 7% a year. Is that a reasonable 60-40?
We'll take it.
So $100 over 7%, 5 years, $100 grows to $140.
No problem.
On the other hand, what if Bitcoin does as great as it might? And a lot of the projections, you mentioned Matt Hogan earlier, a lot of folks are projecting that Bitcoin is going to be $1 million.
You're at 500,000 now?
Yes.
Okay. We'll get into that in a second. Put a pin in that.
That's we'll call it a 10x increase from its current price of about 100,000. So if that were to occur, Bitcoin's future price is far higher. It grows 10x over the next 5 years. If you have a 10% allocation and Bitcoin becomes worthless, the future price of your portfolio will be $126. That's if Bitcoin is zero.
Because you got the gains from stocks, you got the gains from bonds.
Right.
You lost everything in the 10% crypto sleeve. You still wind up going from 100 to 126.
Right.
Disappointing relative to 140, but not catastrophic. If things go right,
you're now 236.
And that's if Bitcoin
hits $1 million.
Hits $1 million per Bitcoin.
And there you see the 25% allocation and the 40%. So even at a 25% allocation, if Bitcoin becomes worthless, in 5 years, you still have more than you started with. You've got $105, even if Bitcoin goes totally broke.
Bitcoin goes to, you have 25% allocated, let's just say strictly in Bitcoin.
Yeah.
Okay. If Bitcoin goes to from $100,000 per coin today, you go from $100 in your portfolio to 105.
Yeah.
So it sucks, and you lost a big chunk of your assets to Bitcoin, but the rest of the portfolio bailed you out.
Yeah, you're still no worse off than where you started. You don't have much profit, but at least you didn't lose money.
Now, this is a great thought exercise, but as you know, and everyone knows listening to this, in reality, most people are not going to allocate once.
Yes.
They're going to allocate over the course of their life.
Correct.
Which complicates the return assumption, but the illustration is still worthwhile.
Absolutely. And we know that from dollar cost averaging, by slowly adding to your portfolio, you improve the MPT
Well,
statistics.
most people do the opposite.
Well, true. They'll buy high and sell low.
They'll take a 1% allocation at 100, and then at 150, they'll raise it to 10%.
No question.
Okay. This is just human nature. We can't fix that.
And we also, you can't fix stupid, right?
Right.
And we also know that people aren't going to rebalance the way that they should. They're not going to tax loss harvest the way that they should. So this is an incredibly simple example of a one-time investment, buy and hold for 5 years. And it shows pretty compellingly that the worst case scenario ain't so bad.
Yeah.
And compared to the upside, because the upside has such incredible potential that it dwarfs the downside.
One thing that's interesting to consider, and we don't know this because we only have 15 years of Bitcoin data. A lot of people make claims, oh, it's correlated with the stock market. Oh, it's correlated with gold. Oh, it has no correlation to anything at all, which is probably the truth at this point. But there are periods of time where it looks just like the NASDAQ. And I think the nightmare scenario for investors considering a 10% allocation is, well, let's see. In this scenario, 10%, I'll have 50% of my money in stocks, 40 in bonds, 10 crypto.
Yeah.
Okay. In that scenario, think about how dominant technology stocks are in the S&P piece. Yeah. So I get wiped out there, 30% bear market,
yep.
and I lose 50% in crypto.
Yeah.
I diversified my portfolio. That's the thing that I think makes people the most nervous.
Yeah, but is it any worse than just owning the S&P?
Well, I don't know. I'll let you know when it happens.
Yeah, I mean, in the S&P, as you noted, a third are in the Magnificent Seven, a third of all the money. So is it any worse having a third of your equities in 7 stocks as opposed to having a third of your money there plus another 10% elsewhere?
Well, if Bitcoin acts exactly like NVIDIA does, I'll let you know. And so a lot of people would say, yes, this is worse, but not necessarily.
But I would also argue that we're talking about a static environment, and we know that as life actually evolves, we're going to evolve our portfolio management.
Fair. You make a pretty pointed remark toward the end of the paper that I wanted to share with people. And I think one of the things that you talk about is you can't have an investment that's gone up 1,000x and still have the same opinion of it as you did at the beginning. And then you cross over and say, not only is it responsible to make sure your clients are allocated to Bitcoin, it's actually irresponsible not to. Mm-hmm. A lot of people would say like, well, I also don't allocate to REITs. Is that irresponsible? I also don't allocate to international small caps. Is that irresponsible? So I do think that there is room for the crypto skeptic to say, okay, that's your opinion. My opinion is that's just speculating on price with no cash flows, no fundamental underpinnings. And I think Ric is crazy. How do you answer that?
Yeah,
And I'm sure you have before.
A couple of different ways. First, I get it. That's a
Well, what's your exact wording? What I can't find where I got this from.
where I talked about whether you're a fiduciary or simply an order taker.
Yeah. All right. So let's key off of that.
I get the skepticism, but to say that it doesn't generate any cash flows, well, that might be true of Bitcoin, but it certainly isn't true of Circle or of Coinbase or of other companies in the crypto space that are equities. So I think it's a misnomer to simply equate the entire universe of blockchain technology with Bitcoin.
Yeah.
You might be making an argument you don't want to buy Bitcoin. Fine. That doesn't mean you stay out of the asset class entirely.
Okay.
The other thing to keep in mind is that if you believe in passive investing, which I think most advisors do these days, and portfolio diversification, then you would argue that you want to basically own the market. That's why you're buying the S&P 500.
This is now part of the market.
Crypto represents 3% of the market. So if you own zero, you're essentially shorting the market.
3% of all the wealth in the world?
3% of the U.S. wealth
is in crypto.
Yeah, if you add up stocks and bonds and real estate and gold and et cetera, you would discover that there's about $111 trillion worth of wealth in America, and the crypto market is $3 trillion. That's roughly 3% of the total marketplace.
Okay, so what's interesting is that's how it flips. So originally it was more like I choose to make no decision on Bitcoin. I'm just not involved.
Right.
Now, if you have no crypto exposure and don't offer it at least as an option to clients, your point is you are making an active decision now. Now you're not just like abdicating your or now you're not just saying I'll leave it up to the client. Now you're actually actively deciding as a fiduciary, I don't invest in crypto. And you might end up being right for some period of time, but it's active. It's no longer a hands-off thing.
Exactly right.
Okay.
And so my challenge to advisors is merely to make an informed decision. Don't go on assumption or conjecture or the recent past of 5 years ago where the world of crypto was totally different. I want you to prove to me that the claims you're making as to reasons not to invest are valid today. They might have been valid 5 years ago. That doesn't mean they're valid today. Because if you are relying on incorrect or outdated information, you're making a mistake that could harm your client's financial future.
All right, this is you. If you're fearful that recommending crypto could cause a client to fire you, then you're suffering from a conflict of interest. And you know that if you can't avoid a conflict of interest, you are required to disclose it. So simply explain that to your client. Quote, from my research and training, I am convinced that crypto belongs as a part of your diversified portfolio, but I've been afraid to tell you that out of concern that you might terminate our relationship. May I share with you why adding digital assets to your portfolio is in your best interests without my worrying that you'll fire me? Do you get the sense that a lot of advisors really think they'll be fired for broaching the subject?
Yeah, I
think it's the opposite.
I hear it all the time, Josh.
These must be people servicing extremely a population of much older people is the bulk of their business.
I would agree with that. These are folks who are saying, look, I don't want to push my client into doing 2 or 3% in Bitcoin because they'll be so angry at that. And they said to me, don't ever dare talk to me about Bitcoin. I don't want to risk my client's relationship over a 3%
You're saying you
allocation.
have the obligation then to at least explain why they should listen.
Yes.
And not force them to do it, but just say, this is why I'm doing this with my other clients.
Because the clients themselves don't have the facts. They have the same misconceptions that you have.
They see you know what they see? Stick a banana to the wall with duct tape. It's and some crypto asshole is going to buy it. They see
FTX.
NFTs. They see Sam Bankman-Fried. And all of those things are real.
Yes.
They read about a different scam being busted in the newspaper.
Right.
So it's not.
And half of them are Democrats listening to Warren.
Right, who is demonizing the space since day one. So it's not without reason that these concerns exist among
So let's
older
take
investors.
the extremism out of it. Let's take the politics out of it. Let's take the emotion out of it and simply say, I'd like to talk with you about why I think this might make sense for you. I'm just afraid that you'll fire me by making you mad. And if you put it in that kind of context, the client would be like, all right, I'm willing to listen. The conclusion may be the same, but at least it's an informed decision.
I would imagine with the success of Bitcoin's price, Coinbase near record highs, Circle being the biggest IPO of the year outside of CoreWeave. I would imagine that these conversations have only just gotten easier and easier,
For sure.
especially if you're talking to the half of the country that loves Trump.
Yeah.
So I think it's probably easier to broach the subject. And maybe it's the advisor that's more hesitant just because there is a lot of volatility in this asset class, and volatility leads to uncomfortable conversations.
Yes.
And it also leads to being fired, even if it's an inconsequential amount of someone's portfolio. It's putting somebody into a coin that's at $80,000 that drops to $30,000. There's no way to explain, yes, but I still did the right thing.
Yeah.
Even though we know that this is not always about outcomes, it's about process. We know this is long term. It's still very difficult for a fiduciary advisor who's gone through the CFP certification process to say, I'm going to deviate so wildly from everything I was taught and do this untested thing.
And there's an elephant in the room we haven't mentioned yet. Keep in
Getting
mind,
sued, arbitration.
beyond that, Josh, you're right on those. The average advisor, 50% in this country, personally own Bitcoin, but only 20% are recommending it to clients. Why? Because their firms won't let them.
Yeah.
It's the compliance officer who isn't saying yes, because the compliance officer often knows nothing about crypto and they can't say yes to something they themselves don't understand. And they're also thinking about their career risk. I don't want to say yes, have it blow up, I'll get fired. What's in it for me to say yes? It's safer for me to say no.
Yeah.
On Wall Street, as we know, everybody loves to be second. Nobody wants to be first.
Well, that's a good point, because the first pioneers who made the run out to Oregon had arrows in their back. And then the second pioneers say, oh, okay, we won't go that way. We'll go a different way. So this is also human nature, but there's also safety in numbers. And so if you are an advisor who's on the fence, you don't have a solution yet, you haven't picked one of the 13 ETFs, you haven't found an SMA manager, you haven't wrapped your head around, well, maybe, I should look at the next IPO that comes along. Like if you're not quite there yet, the thing that you're thinking is, I'm going to do this wrong.
Yeah.
And I'm going to be the one. And look, we launched a crypto index with Wisdom Tree in 2021, right at the old top for Bitcoin, I would point out. But the idea was not, all right, let's get this into everyone's portfolio. What we basically said was, we have a way to invest in, I guess it was 10 or 11 different coins. Some of these are zeros, some of these are 10Xs. We don't know which is which. The research was all done by Jeremy Schwartz's team at Wisdom Tree. They're super passionate about this. They're going to follow the coins and they'll update the index. And we're not going to actively manage it. We don't know anything. If you want to do this with some portion of your wealth, you could do it. Great. We do it. The market crash, the Bitcoin market crashes anyway, alongside the NASDAQ and everything else. And that immediately triggers, industry-wide. Anybody who said anything about crypto got an examination. So we did the examination and it was fine. But the point is, a lot of RIAs are not equipped to withstand the scrutiny that could come along with getting this wrong. Or, okay, it's okay that you did crypto, but you did it the wrong way. We don't like the securities you picked. We don't like the allocation you picked. We don't like the custody solution you put in place. We don't like the compliance oversight you did in vetting the instruments. Like, these are the things that I think there's 18,000 RIAs. Most of them really don't want to go down this road if they don't have to. The price pressure is forcing them to. So I don't know what the standard thing is now. Is it buy IBIT from BlackRock and just everything else will work out? Or like, what do you see people doing now?
For those who are new to this and recognize everything you just said and just want to have an exposure, check the box, call it a day.
Check the box, buy one ETF and tell your clients, good news, you're in crypto.
Exactly.
And BlackRock's going to deal with the bullshit, and we wish you well.
BlackRock, Fidelity, Franklin Templeton, Bitwise,
Wisdom Tree, Grayscale, Cathie Wood.
It's simple and easy to do. They're ETFs, so they trade like ETFs. You are familiar with them. The tax reporting is simple and easy. You can rebalance very simply. It checks the box. And just do that and move on.
I want to end with why you think this is so important. And the reason is extended lifespans. And I've heard you speak about this topic for, the last 10 years or so. And you're really passionate about this idea that all of the leading causes of death you could even throw in DUI. We got the Tesla robo-taxi over the weekend. Every major leading cause of death in America, the stats are going to start getting materially better, especially in the AI age.
Right.
We're going to have drug discovery on steroids. We're going to wipe out all of these things that humanity has lived with for 100,000 years. You really believe that we're going to see that material change, or we're already seeing it now? Talk a little bit about why that makes you need to take more risk and own volatile assets.
Yeah, it's all because of medical innovation brought about by computer technology, nanotech, biotech, bioinformatics, fintech, contributing to all of this.
Gene editing.
All of it.
Right.
We've got CRISPR technology, we have focused ultrasound, we have the human genome, and what's coming is the Human Cell Atlas, which will be released this year or next.
What's the Human Cell Atlas?
They're mapping, the human genome mapped the DNA. The Human Cell Atlas is mapping the cells, the individual cell types.
A billion cells.
There are trillions, but there are tens of thousands of cell types. They've already found thousands in the brain, hundreds in the gut. And once we can map the cells, we can then develop treatments for them. So this is revolutionizing healthcare in America. Go back to the 1800s. Leading causes of death included syphilis, and pyemia, typhoid, cholera.
Right.
When's the last time you saw somebody dying in the U.S. of cholera?
Well,
TB.
we're trying to bring that back. That's an RFK project. We're rooting for them.
So the leading causes of death today are heart disease, respiratory illness, obesity, diabetes.
And all the cancers.
Cancers and Alzheimer's. We're going to be curing all of that stuff. By the time you get to 2050, leading causes of death are going to be homicide, suicide, accidents, war, pandemics. So aside from those horrors, we're going to be alive because we're not going to die accidentally or inadvertently. Self-driving cars are a great example. Self-driving cars don't drive drunk. So it's massive change on longevity.
You give the example, a 60-year-old might have 50 more years to go.
Right.
Or 40 more years to go, or whatever the case may be. You're going to need a lot of upside in a portfolio if you're not working anymore.
What would you say to a 20-year-old who wants to invest? They just got an inheritance. 20 years old, they got $100,000. What percentage of it would you tell a 20-year-old for their retirement to put into stocks?
We do this, and we tell people 100% stocks.
Of course you do.
That's my own portfolio, and I ain't 20.
Because you've got so many decades to go.
Yeah.
But if you're at 60 with decades to go, why wouldn't the 60-year-old also have 100%?
So now you're probably past your peak earnings years, or you're in them.
Right.
It's unlikely you'll be able to work and earn at the pace that you had been for the prior 3 or 4 decades. But the money's going to have to go a long way.
And there's another element to this. When I was in my 20s, in the 1980s, bonds were at 14%. And they've come down to, we saw, near zero, hovering now in the low single digits, which means the great bull market of bonds, my entire investing career, is over.
Yeah.
We're not going to see the kind of wonderful bull bond market over the next 30 years.
Mathematically, you can't.
Exactly.
Right.
So at the same time, we're going to need more equities. Bonds are not going to deliver the returns that historically we've grown used to. All of that explains why we need a greater equity allocation for much longer. And technologically, you need to be invested in the technologies of the future. And crypto is one of the leading ones.
So I've been an equal part crypto curious and crypto skeptic. Mm-hmm. As you know, I haven't gotten everything right. I'm allocated to crypto. I hate a lot of people that I see come along and become charlatans in the crypto space. Mm-hmm. That's a big turnoff factor for me. Given my own background in retail brokerage, I know one when I see one. But then I think generationally speaking, my opinion doesn't really matter anymore. We've got 30 million people with Robinhood accounts. They look at crypto and stocks interchangeably. You can talk to them until the cows come home about, well, stocks have cash flows, and a lot of these coins, they're just based on what the next person will buy. You can do all that speechifying, and in the end, they're just unmoved by it. They do what they see their peers doing. Mm-hmm. They are not interested in hearing arguments for why it won't work. They're more interested in hearing arguments for why it will. You're on the right side of history only because even if advisors my generation and older don't agree with you, the portfolios that advisors will be managing over the next 20 or 30 years are going to come from the demographic where crypto and stocks are interchangeable and second nature.
Right.
So like this is, whether people like it or not, this is just what allocations are going to end up looking like. Maybe not a year from now in the wealth space, but directionally, that's where it is. You feel that way?
Very much so. And I'll turn it into a practice management conversation. My most popular course is called How to Build Your Practice by Hating Bitcoin. It's not about liking it or even recommending it. It's about understanding that a whole lot of your clients own it and they don't know what to do with it. They don't understand crypto financial planning, crypto taxation, crypto estate planning, crypto philanthropy. Yeah. This is a wonderful opportunity for you to be of greater value to your client. And in the course of that, you'll gain more assets under management. You'll gain more referrals. You'll build your business by serving your client. It has nothing to do with liking it or recommending it. It's recognizing it's a part of the marketplace and you can't ignore it anymore.
Clients are going to come to you with commercial real estate.
Yeah.
You may not be bullish on commercial real estate. It's not the point.
Right.
I totally agree with you. All right. Ric, this has been amazing. Is there anything that hasn't been said that you wanted to get out?
Well, I encourage folks to download the white paper at DACFP.
Tell us where to do that.
You can do it at DACFP.com, DACFP.com. It's free. And take a look at our CBDA program. This is where you get certified in blockchain and digital assets, an online 18 CE credit course with a world-class faculty so you can really learn what all this is about.
The legendary Ric Edelman, ladies and gentlemen. Thank you so much for joining us. We'll be sure to point people toward those information sources. We really appreciate you and all of your insights today. Thank you.
It's a pleasure, Josh. Thank you.
All right, that's it from us. Like and subscribe. Talk to you soon.